Welcome everybody to Volatility Trading Strategies. So today we're going to talk about investment performance benchmarks. And I feel like this is an underappreciated topic, but benchmarks are actually really important for a couple reasons. First, of course, because performance matters. And in fact, I'd go as far as to say nothing else matters more. Sure, customer service and being available for clients to interact with and get all their questions answered, being professional, all of these things matter. But at the end of the day, a fund manager could be the nicest, most hardworking person in the world. If your money isn't growing, then it's not going to matter. And of course, there's millions of fund managers all over the world, so we definitely need a simple way to gauge which ones are doing a good job and which ones aren't. But a second important reason for understanding benchmarks is it can actually help you become a better investor. If you're out there thinking that a 3% rate of return is good, then that might cause you to be too risk averse and avoid anything that might get you a decent rate of return. And on the flip side, if you're out there thinking that 15% a year is average, that might cause you to take on excessive risk, trying to outperform that number that you have in your head. So it's really important that investors know what a good rate of return is, what's realistic, and in what market environments might that be happening in. So today I'm going to outline a few benchmarks just to help you focus your investing goals on more attainable numbers in the long run. Alright, so we're going to kick things off here with the best of the best, hedge funds. Now, we all know that hedge funds represent the cream of the crop in the investing world. They have all the advantages. They bring in exorbitant amounts of money, they have power of influence over the markets, and as a result, they're the ones making most of the money, and the rest of us average investors just can't keep up. I'm just kidding. Actually, hedge fund performance is a pretty low bar, so we're starting at the bottom. Here we're looking at the performance of the HFRI Hedge Fund Index. Now, there's other indexes as well, but they're all pretty similar and they do tell the same story. The reality of actual hedge fund performance doesn't nearly measure up to the reputation. For this first set of comparisons, we're starting in January of 2012. There's nothing particularly significant there, other than that's the date that my own fund performance begins, so it's where I always start. And in the last nearly 6 years now, the HFRI Hedge Fund Index has averaged 4.93% annualized. Now, is that higher or lower than you thought? Probably lower, right? As I said, hedge funds have quite the reputation, and we have to remember that they're not even available to all investors. To even access them, you have to be what's called an accredited investor, either having a net worth of $1 million or an annual salary of $200,000, $300,000 if you combine with your spouse. So if you work hard, separate yourself from the majority of your peers, you'll have full access to the exciting world of hedge funds. Now, whether you want to or not, I'll leave that up to you. But that's hedge funds. But now let's move on to something that's both available to everybody and significantly better at the same time, and that's the VBINX. The VBINX is a Vanguard balanced index fund comprised of roughly 60% stocks and 40% bonds. With great performance and a low expense ratio, it's really one of the best, and you can never go wrong with Vanguard. Now, nailing down exact numbers on this isn't possible, but based on financial industry reported results and performance studies, it's fair to say that the VBINX probably outperforms about 80 to 90% of active fund managers around the world. Imagine that, something that is virtually free to invest in, and as simple as it gets, can outperform the majority of wealthy hedge fund managers. Annualized return over the last 6 years is nearly 10%. Now granted, that's entirely during a raging bull market, which is why later on in this video I'll include the financial crisis. But the VBINX is likely in the top 80 or 90th percentile in the long run. Not too bad. Our third benchmark is going to be only slightly more complicated, but it's one that I actually like better than the VBINX. It's a buy and hold portfolio comprised of a 50% allocation to the S&P 500 through the SPY, 25% to bonds through the TLT, and 25% to gold through the GLD. Now you can see that the performance has been a little lower than the VBINX in the past 6 years, but that's largely because gold took quite a tumble from 2011 to 2015, crashing over 45%. Despite that, though, I still feel like gold is worth holding, especially as we push onward in this now second longest bull market in history. It's clearly not done yet, but it's got to be getting long in the teeth, and gold may yet still have its day in the sun. But 7.87% for this fund is still pretty good. Now, I'm not a buy and hold investor, and I'm certainly not happy just matching the performance of index funds, so I need a benchmark to measure my own performance against. But the problem is, there's really nothing out there that is significantly better than the VBINX, so I've had to create my own benchmark. I call it the 1% a month fund, and it's exactly that. It's a fund that makes a constant 1% a month rate of return going forward. Annualized, that equates to a 12.67% rate of return. Over a 6-year bull market only period, that's already a high performer. But going forward from here, with stocks at all-time highs and interest rates at all-time lows, I don't imagine more than maybe 1 in 100 active fund managers will beat that over the next 20 years. So it's a great benchmark, and it's what I compare my own diversified portfolio against. Now, I've mentioned this already, but this is in fact the second longest bull market in history, and it's important that people remember that. As the old saying goes, everybody's a genius in a bull market. So it's important to know what a realistic rate of return is when you factor in both a bull market and a bear market. So we're going to look at the same 4 benchmarks, this time going back to January of 2007, so we can include the crash. Again, starting at the bottom, we've got the HFRI Hedge Fund Index with 3.65%. Why there's trillions of dollars in these funds, I have no idea. But the one redeeming quality is that they do perform better during recessions than something like the S&P 500, for example. The problem is they're worse during bull markets and they lose all of that advantage. But only down 20% during the financial crisis wasn't terrible. Still though, it doesn't take long for a passive index fund to catch up, and the VBinks here is still nearly twice as good with a 6.3% annualized. Now you can see why I prefer the 50-25-25 fund that includes that gold allocation. The crash recently was bad, but when viewed over 10 years, it's certainly been well worth it, and in my personal opinion, I think that will continue to be the case going forward. It may not be a world beater, and it may not reach the stratosphere like some of the gold bugs are predicting, but I do feel it's well worth a smaller allocation. Now I'm going to have to adjust the scale here to account for my own benchmark of choice, the 1% a month fund. The longer we give this fund, the better it's going to perform on a relative basis. I know it doesn't sound like much, but 1% a month is no joke. And like I said, I don't think it's an exaggeration to say that perhaps only 1 in 100 fund managers will beat this over the next 20 years. It's going to take some real out-of-the-box investing to achieve that. So were those benchmarks higher or lower than you thought? Regardless of which way you answer that question, I think it's important for investors to understand that in reality, a 7% rate of return isn't that common. A lot of fund managers talk about 7% a year, and if you've ever taken a meeting and gone through the standard pie charts that they let you choose from, that's the typical number they throw out there. But the evidence just doesn't support that. In a bull market, sure, it's not that uncommon, but investment results are only meaningful when they're measured over longer periods of time that include the bad periods as well. That's when the true rate of return reveals itself. Now, of course, everything that I say in my videos, it also applies to me. I've also done very well during this bull market. So far, well ahead of my 1% a month benchmark. But I'm not going to do a video specifically on the 1% a month until the S&P 500 goes through some turbulence. It's been over 18 months without even a 5% correction. I'm probably one of the few that's actually looking forward to the next recession, resetting this low volatility environment that's been so frustrating, and also so we can get an accurate gauge of how everybody's doing. But hopefully that helps you out. I don't want people holding 100% bonds because they think a 2% rate of return is good. But I also don't want people buying double leveraged volatility products because they're chasing something that's unrealistic. Of course, we're going to continue to try to do the best we can. But understanding benchmarks keeps our egos in check and our expectations manageable so that we don't make any unforced errors going forward. So thanks for watching. As always, if you have any questions about this video or any of the other ones that I've done, feel free to reach out anytime. I'm always here to help. See you next time. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.